In times where the market is volatile and options prices are through the roof because of IV and volatility, there is an easier way and a cheaper way to actually take advantage in these underlying assumptions that you do have without allocating all your capital into just one over leveraged position. So instead of just purchasing really, really expensive juiced puts or really, really expensive juiced calls, you can actually sell credit spreads and play your assumption on the way down, and actually you are making your probability of profit higher. You are it's usually better for your risk management, and it's easier for your overall allocation of your capital, and you're still participating in your underlying assumption move, right? So if you still think it's going to go down, you are going to sell a call spread. If you think the instead of buying a call and you think the market's going to go up, and there's your stock you're underlying you trying to play is going to go up, then you would sell a put spread. So in this video, we're going to discuss how to actually place a call spread. Now, what you would do is the market conditions you would look for when you're trying to play a spread, such as Apple in here, and you want to play it to the downside on the call side. Basically, what you would say is, well, these puts here are a little too juiced for me, right? So I have to get something with a high delta, upper 50s to a 60 delta, and I'm going to be over $1,000 just in this. I'm also going to have time against me, right? Because this is going to have a shelf life. And I don't want to allocate that much capital in here, but I still want to participate in a down move. Or you can go over here and you can say, hey, you know what? Actually, I'm kind of counting down from these marks here. And it's looking like that if I go $10 this way and $10 this way, that my calls are actually trading richer, which they obviously are not in this example. But this is just hypothetically speaking, you would say, hey, you know what? I think I got some call skew in here. I'm going to take advantage of this and play this to the downside rather than purchasing a put, where if I can place a call spread, I can suck up some of this volatility. And then once this reverts back to a normative skew, then I will make money, even if the stock doesn't do anything. So those are some reasons why you would be placing a call put spread. But for whatever your reason is, we can go ahead and we'll show you how to place one on here right now. So we're going to be looking here in our May 16th options expiration, and we're going to be in ticker symbol AAPL, and that's going to be Apple. And what we like to look for is obviously we're going to place this out of the money, but we want to keep our strike kind of close to the money because we still want to have a lot of premium that we want to suck out. So we're going to sell this 40 delta right here. It's 44 delta actually. 200 call right here in Apple. Now, this is a lot of juice. You can see that obviously the deeper in the money we get, it's more expensive. So the one we sell, that is what we want to be as high as we could possibly get it without kind of breaching our assumption in here. So we don't want to sell something that's super in the money, because if Apple just kind of expires where it's at, well, then obviously we don't have a chance of making money, or we have a worse chance of making money rather than actually making money in here. So that is why we're picking this 44 delta. Obviously, you kind of go around the 30 delta. That's where you kind of want to be at. But it depends on your risk profile, how much money you want to allocate, and how much risk reward you do want to take. That is also key. And you're going to see that here in a second. So we're going to sell this 200, and then we're going to purchase, we're going to do $10 spread in here. We're going to go $10 wide. We're going to purchase this 210 in here. So sell the 200 call, purchase this 210 call in here. How do we get 375 as our mid price? Well, because this 200 is trading 695, 705 right now. Mid price is going to be 700. Your 210s trading at 320. Your ask is 330. Mid price 325. 700 minus what is that? 325 class. That gives you 375. That is how you get your mid price here on your credit receipt. Now, we do know how much credit received we get. Now, how do we understand what our max loss is? What we're going to do is we're going to take that net credit received and we're going to subtract it by the width of our strikes. What is the width of our strikes? It's going to be $10. So $10 and you subtract 375 from that, that is going to be your max loss. Your max loss right here, 625. So this is also the buying power that we need to place this trade. Whereas we're going to place, if we're trying to play a put over here on this 200 side right here, we want, you know, we always want to keep that high delta. We would have to pay $1,200, so $1,200 to play this, or we can sell this spread and our buying capital is cut in half. Obviously, our probably a profit went higher, but we're not going to make as much. Well, the max profit we can make is only going to be your net credit received. So whatever they give you, whatever you sell it for, that's what you're going to get. You cannot get any more money. Kind of like if I buy something from you for $10 and then you ask me for more money after I already purchased it, guess what? You're getting $10. That's it. That's all. You're not getting anything more. anything more or anything less. Now, because we're trading this spread in here and we're actually selling options, we have theta on our time or on our side. So time is now on our side as well. Theta is positive each day, all things being equal. We're making 375 off this. Our delta is negative 17. So our delta is less than what it would be here. If we bought this, our delta is going to be negative 60 or negative 50, right? Well, here our delta is only negative 17. So we still have that negative delta, not as much, but we still have positive theta. Whereas if we just purchase a put, theta is going to be negative. It's going to go against us, right? Probably a profit in here is at 64%. So we have an over 50%, over 60% probability of profit in here just placing this trade. And then we do not have to hold this until expiration. We can hold this as long as we want though. And then if say Apple all of a sudden tanks, right, and it goes back down to 180, and then all of a sudden our credit starts trading for right around $1, well, guess what? We can buy that back for $1 and we just made 275 on a trade. That is how you can close that out. So it's a really good way to take advantage of some skew if you want to participate in a move with some with a little bit less capital, right? So we cut our capital, our buying power in half in here, and we're still participating in a down move, and we have a better probability of profit. And overall, it's just a better way to get theta and time on your side. So that is how you would place a credit or a call credit spread or a call put spread, I guess. Bear spread, it would be. And overall, it's just a nice way to take advantage of this juiced up IV in here that we get. So when you get these big swings in the market, IV gets high, your option prices get high. It's a great way to kind of suck this out because maybe tomorrow Apple only moves down $2 and all this volatility goes away. Guess what? If Apple doesn't do anything, then guess what? You just made all that money, even though it didn't even do anything. So that is how we place those spreads in there. If you want to see our videos on how to place bull put spreads, you can go ahead and find that in our Discord as well. But all in all, that is how you do it. And that's what we're looking for when we are trying to place these spreads. All right, guys, if you like this video, make sure to check us out on all of our social media. We also have a Discord service here if you are interested, and you can find all of our socials in the description below.